Hello and welcome to our latest episode of the Market Misbehavior podcast. My name is Dave Keller. I'm the president and chief strategist of Sierra Alpha Research, and it's such a pleasure to bring this podcast to you every week. Our goal is to sit down with top market practitioners, analysts, strategists, portfolio managers, brokers, traders, authors, educators, anyone that we can chat with to get a sense of market awareness, get a sense of market updates and insights to pick their brain in terms of how they are approaching and digesting all of this crazy flurry of information that we get in 2025, how they are taking a step back and trying to make sense of the markets in uncertain times, and what lessons they've learned through their careers that can help inform their decisions today. Our podcast has taken us to a lot of fantastic conversations, from structuring options trades to deep dives on volatility to macroeconomic themes to the latest headlines to technical support and resistance levels and anything and everything in between. And today I have a very fun conversation to share with you. This is with Vince Randazzo. Vince is a fellow CMT, a chartered market technician, which means he knows technical analysis very well and agrees to abide by the high ethical standards as required by the CMT, which is super important to me, and I know our other members as well. Vince is the founder and chief market strategist of ViewRight Advisors based in Florida. His career, as you'll hear when we start talking, he's literally worked with some of the giants in the technical analysis community. He started his career at Morgan Stanley on the desk and sat around the corner from Rick Bensignor, which I actually didn't remember until I was interviewing him. I was like, oh, wow, because Rick was one of my predecessors at Bloomberg and a fantastic technical analyst, great career at Morgan Stanley and some other firms as well. He also worked with the great Paul Desmond, who was again, one of the founding members of the MTA, now the CMT Association, a legend for market breadth, for simplifying what can be a confusing market message. Paul's no longer with us. He passed away years ago, but I feel like he would absolutely love addressing markets like this and translating all the craziness into very specific takeaways for his clients. And Vince is really following on and standing on the shoulders of greats like Paul Desmond to simplify that market message here today. We talk about his Market Seasons Barometer, why and how he charts and tracks a rotation from the summer of 2024 to more of a fall and now a winter in 2025. What sort of things he would need to see to sort of declare more of a springtime for the financial markets. We talked about, just paying attention to the evidence of the markets, not focusing on emotions, but focusing on evidence, which is a message that really hits me home, because that is very much what our goal is at Market Misbehavior, to help people focus on evidence as opposed to emotions, particularly in involving their investment decisions. Vince dropped a fantastic quote: "The market is infinitely smarter than me." And just, again, not trying to outsmart the market, just trying to understand it, just trying to track the evidence as it evolves. There's a great conversation, really perfect time here in mid-April of 2025 to get some level-headed, very systematic, very simplified but powerful market analysis from Vince Randazzo, CMT, founder and chief market strategist at ViewRight Advisors. Please enjoy. So I'm super excited to be sitting down today with Vince Randazzo. Vince is the founder and chief market strategist at ViewRight Advisors. I've known Vince, you for a number of years, and it's so good to catch up with you here. Thanks for coming on the podcast for the first time today.
Of course, man. Yeah, I'm glad to do it. Appreciate the invitation, and really, really excited to be here.
And it's funny, you and I spoke a couple of weeks ago, like a month ago maybe, and I feel like the world has changed in so many ways since you and I spoke last. So I had some general things of what we could talk about. We'll probably get to a lot of other things given the changing market environment. But start us off here for those that aren't as familiar with you and your work. Give us the quick backstory. How did you get to this point, and sort of what's your journey been as an investor?
Yeah, so man, I've been at this since summer of 2002. So
Right.
that's when I graduated college, and my first job out of school, equity research sales desk at Morgan Stanley. And it was just like, I just remember seeing the Dow down a bunch every single day. And I was like, man, I don't know how long this is going to last, So
It's a
it was great.
temporary position potentially, right? At that point.
Yeah, exactly. I was like, I don't know. I might as well be an intern,
Yeah.
Um, but I was lucky enough to work with some really, smart, open-minded people who were connected to technical analysis. And I don't know, I think part of that was because we sat right around the corner from Rick Bensignor, who was
Yeah.
our chief strategist at the time on the technical side.
Yep.
And we were kind of influenced by him. And I just remember, going in, out of college, they don't teach you really much about technical analysis, except that it's kind of a little bit out there and wacky, and nobody really likes it, whatever. But so I kind of had that in my head. This isn't maybe something that we should look at. It was all fundamental on that desk. But then all the people around me were sort of like influenced by technicals, and I saw that. And then I saw Rick. He came to our desk. I'll never forget this. He came to our desk and he said, "Anybody have a jacket? I'm going on CNBC right now." This is October, right? So the market is like bottoming. And it was literally the day of the bottom. And I'll never forget it. I see him on CNBC and he calls it. He basically says, "We've got all these exhaustion signals and we think we're hitting a bottom right here." I mean, that was the bottom for that massive bear market. And I will never forget it. It influenced me so much, in addition to the people who were sitting around me at the time. And I said, there is something to this. There is something to technical analysis. I'll never forget that. So then, fast forward a few years, I wanted to kind of formalize that. So of course, go down the CMT route, become a chartered market technician in 2008. And just before that, I had been introduced when I was at UBS to and worked closely with a technician called Peter Lee.
Yeah.
And Peter, he was great because he kind of got me into the thinking of like the market as a whole, as an entity, rather than like single stock analysis. Because that was all like, to that point, I was always like, oh, single stocks was kind of what we did. It was equity research sales. That's what we did. But this idea that the environment sort of frames everything and its importance, and what's going to work and what's not going to work. So I got really into that time with him about breadth and this idea of like advanced decline line and divergences. And I was like, wow, this is like next level thinking, because if we can figure this out, and that's that's what kind of comes to the name of my firm. If we get the market view right, then everything else kind of falls into place, and you're swimming with the current, not away from it, not against it, right? So that was so influential to me in my career. And then, and of course, I went on the institutional side for a little bit. I was an institutional desk analyst, and I used those technical skills in that role as well, talking to hedge funds and big institutions, and it was receptive. There was some reception there. I kind of used that marrying together of like fundamental and technical, which was my background, and I have an econ degree, so I was sort of had the ability to sort of talk in a lot of different ways to a lot of different people. So that was a big benefit to me in my career. But I later in my career, and this is sort of most recent history, for the past 8 years, I was at Lowry Research, and I was working with. I took the job basically to work with Paul Desmond, and I said, Paul Desmond was just to me, the more I studied breadth and the more I studied, market analysis instead of like single stock analysis, he was just a name that kind of kept coming up a lot. And of course, he's really instrumental in the founding of the CMT Association.
Sure.
And just so gracious, as a mentor. I kind of looked at it as such an opportunity to just learn from one of the best who has just seen it all, done it all, and be able to sort of articulate it in a way that is really accessible. And that's what I enjoyed about, being there. So that's kind of my background and history. And of course, now I'm out on my own. And since January, I'm out on my own with ViewRight Advisors. And again, the focus is getting the market view right, and what we do is we just look at the market from a risk reward perspective, and we break the market into 4 regimes as far as like investedness. So we say historically, in this breadth / liquidity regime, what does that mean for returns? What does that mean for volatility historically, right? And they say, okay, well, if this is the case, then this is our allocation to equities. If this is the case, then this is our allocation, right? So it's very, very, very systematic. So it's really just systematizing breadth analysis in a way that is focused on implementation. Because, frustration of mine being in research for pretty much my whole career was like this sort of non-committalness that came along with that. And the frustration I saw like in some of our clients at times, especially times of stress, like when they really want you there, it seemed like, that's when that's when the analysis was sort of least convicted. And I felt like it should be the other way around, and we should really think about implementation, not just, trying to think of the scenarios. Why don't we just look at history and we just say, okay, history and percentages and numbers and figures and determine, okay, so we could speak with some kind of conviction and say, you know what, in this situation, here is what usually happens, right? And X percent of the time it goes this way, Y percent of the time it goes that way. And we make it really usable for people.
There's so much to unpack there, Vince. I really appreciate that. I mean, I want to come back to sort of your evidence-based process, because we spent a lot of time talking about the dangers of an emotion-based investment process and getting more to evidence. And I think you're from what we've talked about with ViewRight, I think you're doing a great job of focusing on the evidence the market's providing back to us. But I mean, I'm struck by the mentors that you had along the way. I mean, these are some giants in technical analysis, right? Rick Bensignor, I mean, for those that aren't familiar, and we haven't had Rick on the show, he was at Bloomberg before I was, and you had a Bloomberg stretch in there as well, which you kind of went through. Yeah,
I kind of glossed over that.
We didn't overlap, but we both have Bloomberg in our past. But Rick had left for Morgan Stanley before I arrived there, and his departure in many ways created a vacuum for me to sort of step into eventually. So I'm eternally thankful that Rick left Bloomberg in time for me to start there, because it introduced me to this whole way of thinking. But a great contrarian. I mean, always very vocal about taking the other side, and with some great calls over the years, which is pretty cool. Peter Lee is one that I don't know how familiar people are, but I met him a number of years ago at UBS. And I mean, to your point, I mean, a great sort of macro thinker, right? A thought leader, sort of combining the technical with other kind of things. And I'd love to dig in a little more into that. I think a lot of people, particularly recently, and we'll get to the current markets here a little later, but I mean, a lot of people sort of struggle with in certain environments, it feels like charts and technical analysis are super meaningful, but in others, it's just news, it's just other stuff. So maybe charts are less valuable. And I think of, I haven't asked Peter Lee, what would you do in this situation? But it would seem to me that combining them in a meaningful way makes sense. How do you kind of triangulate those different inputs, particularly in an environment like this, which is so unstable, it feels like?
Yeah, well, instability is a symptom of the environment that you're in, right?
Yeah.
Higher volatility happens when you have less liquidity. How do you identify less liquidity? Well, usually you have divergences in the advanced decline line and other indicators that tell you that. What does that mean? Okay, to the normal person, that just means that money is going into fewer and fewer stocks, right? I mean, that's what it means. And then what is the divergence itself? Well, the divergence means that the advanced decline line is going down, right? And the market, by measure of the mostly large cap indices, is going up. That's a divergence. One's going this way, one's going that way. Why does that happen? Well, it happens mathematically because there are just more stocks on average every single day going down, right, than are going up.
Yeah.
And, you have to think to yourself as a portfolio manager, what does it do to my probabilities of having a portfolio that is A, going up, but B, outperforming? Very, very small and increasingly small as you get further and further out, in those periods. So the way I would answer your question is that, this is why we need to understand, what is the environment going to give me, right? Is it going to give me a high return environment where I can just swim with the tide? And then, like you said, technicals maybe don't matter as much because it's a rising tide. Everyone's smart. It's all good. So you need to know, when is that sort of transitioning into a period where that's not going to be so true? And then when has it already transitioned, right? Then you need to know, okay, well, then I need to trade with that trend, whatever that trend. Now I have a negative trend. Well, I need to trade with that trend and not swim against it and not fight it. Can't fight. You can't fight the market. All my analysis is based on the fact that the market is infinitely smarter than me, right? Like that is my single truth. in my analysis, right? Like the market is infinitely smarter than me. Okay. Understanding that, what can I do to learn from it so that I'm swimming in the right direction? And
Mm.
that's all that I do. That's the core of what I'm doing.
And
Yeah.
it's so funny how often people get caught on the wrong side of that, right? And it's just missing the clear the flow, right? The flow of the funds really, but the flow of the movement of the markets and just not paying attention to that. You obviously mentioned Paul Desmond, who was one of the founding members of the MTA, now the CMT Association, mentored so many, and I mean, thankful to be able to meet with Paul a couple times before he passed away. And again, in his later years, my experience just incredibly gracious and giving and just super helpful. I mean, it was a pleasure to kind of ask him questions. For those that didn't have the opportunity to get mentored by him for a period of time, what were sort of your big takeaways? Because I think of Paul as sort of a great data gatherer, data, digester, right? I mean, Lowry's was known for just tons of breadth data in particular, and having I feel like when I would read Paul's work, it was just this great view of the landscape. It was hard to not understand what was happening after you read his work. What did you learn? What were your big takeaways from time spent with Paul Desmond?
Yeah. I mean, my biggest takeaways were that you need to make it simple. You need to
Mm.
make you need to make the process simple. You need to be able to explain it in a simple way. And he was a masterful writer.
Yeah.
He was really excellent. And not not in an ornate way. Some people say, oh, they were a great writer, and they sometimes refer to like the eloquence of the way they write. And to me, there was just like a simplicity in the way that he communicated these. As technicians, we can get into our little cubby holes and talk the way we talk, but he made it really accessible. So that was one thing that he reminded me, is like, you don't need to prove that you're smart. You just need to be able to communicate what you're trying to say and
Yeah.
make it mean something to them. But
Yep.
what I appreciated so much, and like you said, he's just gracious, and I think he was just gracious with his time,
Mm.
and sort of just teasing you to be inquisitive, right? Like I think
Mm.
if you were a naturally inquisitive person, and I am, you just got along well with Paul, because he'll kind of match you, and he'll give you all this, another avenue to think in that maybe you haven't even thought of before, and a perspective that you might not have known even existed. And be like, well, this environment now is similar to 1966 or 62 or something like that. And I'd be like, wow. And I would do a little research. I'd be like, oh wow, that's so interesting.
Yeah.
The parallels and the repetitiveness of history.
Yeah. Yeah.
So that to me was those were the huge kind of biggest takeaways with Paul.
Yeah, it's well said. And you're right. I mean, a great writer. And I love the simplicity, very straightforward. And to be clear, there are a number of other really good technical analysts there over the years. Dick Dixon comes to mind as a
Yeah,
really top analyst. Yeah.
Dick and I worked together, and he was the same way, where
Yeah.
he had tons of ideas,
Yeah.
always thinking, and just a disciple of Paul, right? Like, I mean,
Yeah.
he had
Yeah.
worked there for, I know, probably 8 years before I even got there.
Yeah.
So, him and Paul became, really tight and inseparable. And of course, as Paul got later in his career, Dick Dixon sort of picked up the reins and
Yeah.
sort of carried the show. And that was, good on him, because, he carried that spirit along. And then of course, he passed, and I just felt like it was left to me to try to, represent what was there, and the traditions, and try to, produce in the way that they would have been proud of. Right.
Yeah. Well, it's great to see you continuing that legacy, Vince, and I'm seeing that with what you're doing with ViewRight, and hopefully you have much success continuing that great legacy. Let's talk a little bit about the current market environment here. I mean, help us make sense of what all we've seen here in the last couple of weeks. Market topped in February, major averages moving higher. Breadth conditions certainly not great in 2025 going into that peak, and now it feels like everything's changed. Now in mid-April, give us an assessment of the conditions from your perspective.
Yeah. So, I mean, just starting to where we were, like you said, at the start of the year, in our work, we started talking about in like later in early February, we started talking about the potential for a change in the environment, a move to a bear market trend, and we didn't call it that yet, but then by the end of the month, we had gotten our first sell signal in 3 years that basically said that, okay, this is something else. This doesn't appear to be a correction. And then of course we got more, additional information to kind of support that case in the middle of March. And then we said, okay, well, this is more serious. We really have to consider this as a potential, major trend change and something we haven't seen in, like I said, about 3 years. So we have to respect that, my process is all about staying invested as long as you could possibly stay invested, but really just avoiding those high probability drawdowns. So we're identifying market fragility, really, and then there are sort of triggers that go along with that. And again, we saw this in February and then reasserted itself in March before the major secondary drop, of course, with the tariffs and everything. But if you think about, again, knowing the environment and saying, okay, well, the environment frames my story. Well, you had similar tariff news, and I don't want to draw a direct correlation, but similar tariff news in 2017, right?
Yeah, right.
But that was 2017, and the market was super strong. Small caps were as strong as they had been in probably a decade at that point, which meant that breadth was super strong, which meant that liquidity was being just deployed massively into the market. And yeah, you would get these news items in these days, like whatever, but they wouldn't stick, right? Yeah. And I think just kind of shows you just really plainly very similar news, but different market backdrop, and that's the difference, right? You can get bad news in a good tape, and it's really just bad news, and it's okay. But you can get bad news in a sort of fragile tape, right, or fragile breadth environment, and it could change. It could be an accelerant and a catalyst really to the downside, and that's what you need to know. I mean, that's why you really need to know what's my structural, view, right?
You've mentioned the word fragile a number of times. I think that's such a good way to describe this market, and it's not too long ago. I mean, 6 months ago, this market felt, unstoppable. The opposite of fragile. It just felt like this bullet market that would never sort of change. It just felt like this relentless climb. And you see how the market is in a lot of ways overreacting to negative news, right? In a lot of ways here more recently. I think that's well said. You talk about with your new platform, ViewRight Advisors. One of the things you have is what's called a Market Seasons Barometer. I'd love to know what is that telling you about the current market environment? What are kind of the general inputs to that? And is it, are we in winter right now? Are we in spring? Are we in fall? Like what's the takeaway here?
Yeah. So the idea is, right, basically just to know that as it relates to breadth and stock participation, what general season are we in, right? And you can most of the time, the market is in this, what I would call summer, sort of an endless summer. We have our license plates down here in Florida. Some of them say endless summer, right? Because it's pretty much always the same all year round, right? But that's how it is. 75% of the time, the market goes up, right? So it's not like true seasonality. We don't do anything with seasonality. It's all based on breadth, liquidity, market structure, and momentum.
Sure.
And what we do is we analyze those factors as our sort of inputs, and then from that we determine, okay, what's my risk return profile, and then from that you could basically ascertain: are we in summer? Are we in fall? Are we in winter? So fall is like a transitionary period, as you might kind of imagine, right? The stocks are falling out of participation of the bull market, right? So we use that phrase fall, just like the leaves fall from a tree. Paul Desmond used to say that, all the time when he described breadth, the stocks, the leaves are falling from the trees, and that's how you know that, something's changing. The season is changing. So I borrowed that from him, and I thought that was just such a great way for normal people to understand what it is we're trying to say. And that's, like I said, it's a transitionary period. And then you go to basically winter, which is basically just kind of like batten down the hatches. It's risk off mode, guys. Whereas fall, you could still kind of squeeze out gains because, there'll be areas of relative strength that you can kind of go to and hide out in, whether it be staples or whether it be international. We saw that earlier this year, right? Where people can kind of hide out in different places.
Sure,
And
sure.
that's really indicative of a fall type mentality where, yeah, you just have, it's harder as a PM to find those areas, but you can find them.
Yeah.
Winter is like, yeah, those are few and far between. It becomes a liquidity event where everything gets pulled, and bids get pulled, and things just don't think whatever was working, it just doesn't work anymore. And
Yeah.
it's just an environment where you want to look at other asset classes and be really serious about that. Even just T-bills, and I know that's, people will call it market timing or whatever, but it's really just looking back at history and saying what does history dictate, or what is the result or the outcome or probable outcome when my indicators look this way. That's really all it is.
So are we in a winter here in April 2025? What are the charts telling you?
Yeah, according to our system, that's where we're at, winter,
Yeah.
and this is probably something we've got to just deal with as a bear, in the form of a bear market. I mean, that's what
we
it
all
is.
we all are going to have to get in the fetal position and ride it out. So again, you don't have to tell us too much of the secret sauce, but like what general conditions would have to change for it to feel less like a winter and more like a spring-like recovery? What kind of things would you be looking for?
Yeah, no, great question. So basically what we like to look for is some of the washout conditions that are associated with bottoms historically,
Yeah.
right? And that just has to do with some of the breadth indicators that we watch, some of the momentum indicators that we watch, whether it be, percentage of stocks above certain moving averages, whether it be, new lows, all these things are just, items that go into play here.
Yeah.
And then what we want to do is not when they're washed out necessarily, but when we see momentum start to recover, right? So because oversold, and we've seen this in especially the last 4 weeks, right? Where oversold, people can just talk about oversold all they want. It doesn't matter. Oversold is just, it's a construct in our mind. There's no such thing. It just means that there's more supply out there that's coming out, and it doesn't really matter what's over about that. I don't know.
Yeah.
I mean,
it's down a lot. That's what that is, right?
Yeah. So that doesn't necessarily mean that it's ready. It just means that it's a condition, but it's not a signal. And that's what we're doing here, right? We're basically saying, I want to separate the conditions from the signals. I want to separate the signal, high probability signals from lower probability noise, and be very, very explicit and clear about that. So yeah, it's not about catching the bottom. We're not about that at all. It's about sort of being pretty early on the recovery. But you got to get through, some stability first. We don't, for right now, like I don't see a great sense of stability. You had a very sharp drop, and now you're having a pretty, decent sharp rally. That's to be expected. That's what happens in bear markets. You get really nice rallies, mostly to pull more people in, especially early on, and convince them that, it's not a bear market, maybe this is just a correction or something weird we haven't seen before, and everything's actually good. And people might be more apt to draw that conclusion because it might seem that it is news driven. But like I said earlier, and you pointed it out too, that breadth had been breaking down, January and into February. So it wasn't, this isn't a news driven situation. This is a liquidity driven situation, which is how every bear market pretty much starts, right?
I feel like we're so desperate for a narrative to help us make sense of it. So we're looking for that news that makes it make sense. But you're right. I think if there's one thing I've learned from looking at charts for a couple of years is that the charts kind of tell you when the liquidity is changing, right? Supply and demand. And that's what drives things so much. We can find all sorts of reasons on the way up or the way down to justify it. But I feel like that's the beginning. So final question, Vince. I mean, how do you ride out a period of instability like this? I mean, what are you telling your clients? Is it just getting to defensive positioning? Is it getting into things like precious metals that are actually still managing to go higher? Is it defensive sectors? How do you think about allocation and positioning during a period of excess volatility, excess uncertainty?
Right. Yeah, no, great question. I think there's not a one size fits all solution.
Yeah.
Because you've got long only folks that are like, well, I can't really go into T-bills because it's not in my mandate.
Yeah.
So we have, the range of clients that will tell me that. And for those clients, I will just say, well, reduce your beta as much as you can.
Yeah.
Right. You want to neutralize your beta That's really the goal here. It is bringing your beta down. So whether you do that through raising cash and going into treasuries, whether you do that by laying out some short positions to neutralize your beta and your exposure, whether it's call strategy, option strategies, whatever it is, that's how you would do it. But that's the end of the bottom line is like reduce your exposure. However, you reduce your net exposure, right? However you want to do that, or however you can do that. That's kind of how we're putting it. Yeah.
Well, Vince, this has been a real pleasure to chat with you. Great to catch up, and great to get your take on things and learn a little bit about your experiences in the markets. I feel like we've gone from the endless summer of Florida to more Seattle-like weather these days. So hopefully we can talk again when it's more endless summer again. But for now, listen, thanks so much for sharing some insights, and wish you the best with ViewRight.
Thank you, Dave. It's a pleasure, and I always appreciate our conversations.
It was a great conversation. It was interesting when Vince mentioned that he started in the industry in summer of 2002. And, I've often talked with people about their formative sort of early experiences in the markets. And someone like him just being on the desk at Morgan Stanley, that's a great achievement on its own, just getting into a place like that. But sitting around the corner from the technical research department, guys like Rick Bensignor, who were, going on TV, arguing for a market bottom when it felt like an insane thing to do. Moments like that are what really end up shaping your career over time. And I know, with my own experience, I started just a couple years earlier in summer of 2000. And my first 2 years were basically, the popping of the tech bubble and just experiencing. That was my first market experience. And, I had the opportunity to work with a bunch of institutional investors at my time at Bloomberg. And it was fascinating to see and hear and learn how some of them were navigating that period very successfully. Others were absolutely crashing and burning in the most colossal way. And seeing what tools and techniques the successful money managers and strategists used really helped me recognize the values of technical analysis, particularly for risk management, which very much hits home here in April of 2025. I love that quote. The market's infinitely smarter than me. I love how we made the point about separating conditions from signals, particularly talking about oversold conditions, right? I mean, it's not necessarily a signal. It's more descriptive of the condition the market is in. He uses other techniques, particularly a trend-following, breadth-based approach to identify and confirm once a bottom is in, which I think was a fantastic way of thinking about the markets, where so many people are desperate to pinpoint the bottom and call the low as if you miss it by 1 minute, it's all lost. And I think my conversation with Vince realized that from winter to spring, it's more of a rotation of the seasons. Let's make sure we don't miss those changing points of evidence. Great take, and thanks again to Vince Randazzo of ViewRight Advisors for joining me on the podcast today. If you like what we talked about, particularly this idea of a systematic approach to market analysis using the tools of technical analysis and also behavioral finance, which is figuring out the stuff that happens between your ears, our Market Misbehavior premium memberships may be a really good way to upgrade your own way of addressing these markets in 2025. You can find more information at marketmisbehavior.com/premium. 3 great benefits of the premium membership. Number 1, access to all of our members-only reports like our weekly flight plan and our monthly chart review. Number 2, access to all of our virtual courses. Flight School Behavioral Investing is where you'll start. We'll talk to you about behavioral biases, about a systematic approach to technical analysis, what your routines should look like every day, every week, every month. Finally, you'll have full access to our members-only community where you can ask questions. You can learn from the questions asked from others. I'm in there every morning answering questions from some of our premium members about particular tickers, about themes, about indicators, about positioning, about bet sizing, stop losses. Anything is fair game. My goal is to empower you to make better decisions, and answering questions is one great way I've learned to help people along in their investing journey. It's a lot of fun. I hope you will consider being a premium member. If you're interested, look at marketmisbehavior.com/premium. Make sure you use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. And wherever you're at in your investing journey, I wish you much success. Remember, it's always a good time to own good charts.